Hi, welcome to the second part of our handout 15B, where we're looking at how to value entities using DCF methods. So I know a lot of stuff has been thrown at you so far, and there's a little bit more coming, but the good news is that at the end of this part, you're going to have in your pocket a pretty good model for being able to evaluate how much an entity is worth from the perspective of a private equity firm. So I think that's incredibly exciting. Hopefully you will too. And with that, let's jump right into it. Okay, so as we were saying, for the rest of the term, we're going to focus on NPV to owners. We're going to care about shareholders, not so much for all stakeholders. So our NPV equation is going to be here where we want our free cash flows to owners, and we're going to discount with cost of equity capital. So now let's think about how we can simplify this if we're purchasing a firm. Okay, so we're going to have our NPV is equal to minus the price that we pay for the firm. Now remember, that might not be the total cost of getting 100% of the shares, but that's going to be what we put down to buy those shares. Again, we might have the firm take out a loan to help buy some of the shares, as we've done before a couple times this semester. So the free cash flows are going to be those levered cash flows to owners, and we discount here with that cost of equity capital. And again, in words, the NPV for this project by the firm is first big negative at t equals 0 cash flow, the amount we pay to help get 100% of the shares. And then what's positive? The present values. Remember, each cash flow, we take its present value, then we add them up. Present value first, then add them up. The present values of all the future cash flows that we will get as dividends. And that's it. So let's see a couple of methods here for evaluating entities for owners. The first one I want to look at with you is called the dividend discount model, and there are two versions of this model. The first is called the simple dividend discount model, and it says this: the value of the firm to its owners is the present value of all future dividends to be issued. Well, okay, so far so good. That's exactly what we just said on this page, nothing new there. But it also says we're going to assume that the firm will remain in steady state forever. This is important because this allows us to wildly simplify things. Okay, so let's see how that works. If the firm is going to remain in steady state forever, that means revenue is going to never go up, never go down. The costs are going to be the same each year, all that stuff. The market's never going to change for the products. So what that means is in all future years, the cash flow dividend, free cash flow dividend that can be given to owners in any year I is going to be constant because nothing's changing with the firm. The net income is the same, the capex is the same, the depreciation is the same. So the free cash flow that we can extract from the firm is going to be the same in any year. Okay. So if that's true, if we've got a firm that's going to be in steady state forever, and let me emphasize forever here, that sort of kind of should sound familiar, something like what a perpetuity, and that's really true. So the present value of all the future dividends that we're going to get, we can just get from our perpetuity equation. And our perpetuity equation in this context looks like this. The free cash flow that we get in any year is equal to the present value of all those cash flows going out to infinity, those free cash flows, times our equity cost of capital or our equity discount rate. So through the awesome power of algebra, we can solve this equation for the present value of all those uniform cash flows that we're getting out to infinity, and the present value of all those future cash flows out to infinity is the value of any one that we want to take divided by our cost of equity capital. Okay. All right, so far so good. This is going to give us a really simple, straightforward model, but as usual in finance, if it seems too good to be true, it is too good to be true. So let's think about for a second, what are some key improbable assumptions needed for this model? Well, how about forever? Do you think that there is a firm that is going to last forever? I don't think so. Okay, and how about steady state? Is there a firm in the world that's going to be exactly the same revenue, the same expenses, the same capex, the same depreciation every year out to infinity? I think probably not, right? Okay, so we have some really couple of very big assumptions that make this scenario improbable. Nonetheless, for some companies that are going to be relatively steady state for a long time, you think maybe 10 years, 12 years, something like that, this is not too terrible a model. Okay, so the second version here of our dividend discount model is called the Gordon Growth Dividend Discount Model. So let's see what it says. I got to tell you, this one is really wild and crazy. So first of all, it says the value of a firm to its owners is the present value of all the future dividends to be issued. So far, so good. That's what we saw back here. No problem. And now with the growth model of Gordon's here, we're going to assume that the firm's dividends are going to grow at a steady rate G. So that's the G is the growth rate in dividends, like 10%, 5%, 15%, 2%, whatever. Okay. So in other words, our dividends are growing as we can predict the dividend in year I plus 1 by just taking whatever the dividend was in year I and multiplying that by 1 plus the growth rate, okay? And now we're also going to, the Gordon here in his wisdom is also a forever kind of a guy. So he's got this firm going on forever, but growing forever, right? So, I mean, at a certain point, it's going to take over the galaxy, take over the universe, all right? But mathematically, with a firm like that, we have, of course, another infinite series for the dividends because they're going out to forever. And we didn't focus on this previously, and I didn't want to, but you can get a closed form version of the present value of all those future cash flows, even though they're growing forever, with what's called the growing perpetuity formula. And heads up, I didn't ask you to memorize this when we were doing time value of money, and I'm not going to ask you to memorize it now. I just want you to know that the Gordon growth model does exist and how it works conceptually. Okay, so that said, let's just go over the pieces of this equation. So in this equation, FCFE is the first dividend we get at end of year 1 after buying the firm at end of year 0. And PV is PV tot, the present value of all the future cash flow dividends into perpetuity. And then G is equal to our constant growth rate, right? That growth rate G expected for the free cash flows. And RE is the firm's equity cost of capital, just like it's always been from CAPM or whatever. So that's the Gordon growth model version. So what are the key improbable assumptions needed for this model? Okay, so we've already got forever, I think not. We've got now, instead of steady state, all right, it's just not going to happen that any firm is going to be able to grow its dividends at a constant rate forever. At a certain point, it would be bigger than the GDP of the US, and et cetera, et cetera. So this is highly improbable. So for that reason, we're not going to focus on it for these reasons. So why did I torture you with this model? Because believe it or not, it actually does come up in investment banks. Remember, investment banks want to pitch you on a deal. They're not necessarily aligned with your best interests, so they'll make unreasonable assumptions about a firm, and they might use something like the Gordon Growth discount model to show you how great a firm is, that it's going to grow forever. Okay, so now let's do an example. Let's use the more realistic and not completely implausible simple dividend discount model. So let's answer the question, should a private equity firm, PE stands for private equity, should a private equity firm purchase WorkClose Inc.? And we'll call WorkClose Inc. WCI for short. So here's the situation. We've got a private equity firm called Max Value LLC, and it's considering purchasing this firm, WorkClose Inc. Okay, so what are some of the key features of WorkClose Inc. while Max Value is looking at them? So WorkClose Inc. makes clothes for people working outdoors, laborers, equipment operators, loggers, farmers, carpenters, etc. So it's sort of like Carhartt, I'm sure I'm misspelling that, something like that, heavy outdoor clothing kind of a firm. And it's got a stable, steady business with stable future prospects. So they think it's got slow to no future growth, but it's not gonna shrink either. It's a well-managed, privately held family business. So family owns it. Its stock is all owned by the family, not publicly traded. And the family has sort of had enough, and they want to move down to Aruba and give this all up. So they're willing to sell the firm for 100 million firm. So that would be 100% of shares, right? So that would be all the equity of the firm. So here's some 12 trailing month operating data for the firm. The firm's tax rate is 40%. It has no debt, debt-free company. Okay, so no leverage. And here's its latest annual income statement. So they had revenue of $88 million. These are in millions of dollars unless otherwise noted. The revenue, 88 million, depreciation, 30 million, other expenses, 40 million. So their EBIT is 18 million, debt-free, no leverage, no interest, earnings before tax, 18. They pay their 40% tax on that, and they get down to net income of 10.8 million. So this is pretty good for a firm with 88 million in revenue. They have a very, very high double-digit profit margin. Not high double-digit, but they have a high profit margin that's in the double digits. And remember, it's a steady state firm, so this income statement has probably applied for the past 2-3 years. And if it remains in steady state, we expect that this income statement will apply in all future years. So Max Value wants to know, is purchasing this firm a good project for them? How do they know if it's a good project? Well, they do a good NPV model, and if it's NPV positive, then they're going to go for it. So here's how they go about it. They've got to start, you always got to start with your assumptions, okay? So they look at the firm. It's a really well-run firm. They think they can't improve the operations of the firm, okay? And they do believe that this market is very stable, and that WCI is going to maintain its share of this market. So it's going to operate in steady state indefinitely. So that means that the free cash flow dividends that they're going to get out of this firm, if they do buy it, are going to be constant. The free cash flow they can get at end of year 1 is going to be equal to the same as end of year 2, end of year 3, etc. They're all going to be the same because they are using this steady state assumption here. Okay, so if this steady state assumption is true, and they want to be simple about this, they can model the free cash flows and PV tote as a perpetuity. Okay, so this is a very simple model. Okay, so we've got some more information on WCI. The max value is also assuming that the risk-free rate right now that they've developed from treasuries is 6%. So they looked that up on Bloomberg or whatever, and that's what they found. And the RM market rate for CAPM they believe is 11%. That's the average equity market return rate, they believe, okay? And also for comparable publicly traded firms, they went out there and did a bunch of regressions, and they found that beta was equal to about 1.1. And I have the little u there because this would be beta for similar companies that have no debt. Remember we talked about beta increases with increasing leverage. So if you're doing something like this, you want to be sure comparable companies are going to be companies with no debt if you're looking at a company that has no debt. Okay, and why'd they have to use comparable companies? Because WCI is not publicly traded, so they don't have the data to be able to directly get a beta for WCI. Okay, so they have decided that this is part of what private equity firms do. They have decided, and this is over our heads, okay, that the optimal debt to capital ratio for WCI is 20%. So the weight of the debt is 20%. Why are they doing that? Remember the Cowboys, right? Right. Right? We saw this with the Cowboys versus the Conservatives. Increased debt increases ROE in good times. 20% debt to capital, that's not highly levered. That's still very conservative. So they can juice up their ROE a little bit and not have too much debt. Okay. So they're going to, if they buy it, they want the firm to be levered to this amount. So how are they going to do it? They're going to fund the purchase as follows. They'll use 80 million of their own cash. And this is exactly analogous to what we did with the Cowboys when we were talking about ratio analysis. They'll use 80 million of their own cash, and then they'll get the company, not them, but they'll get WCI to take out a $20 million loan with an RD of 7.25%. And that loan will be taken out at the very moment ownership is transferred, and the 20 million that comes in the door to the company will immediately go to the family with the 80 million of max values cash. So the family gets a total of 100 million, and now the company has this $20 million loan. So the company is going to be levered, right? And this, again, when you do something like this, it's called a leverage buyout because you're using leverage, you're using some debt to help you buy all the shares of the firm you want to buy. Okay, so a little bit of terminology now, not too much. We say in a case like this that the post-purchase capitalization of the firm is 100 million. So that's D plus E. So the D in this case is 20 and the E is 80. And that's also called by a lot of folks cap tote. This is the same thing that we called enterprise value when we were doing ratio analysis. Okay, so as I pointed out up here, we've got our D is 20 million, and that's the amount of the purchase that's funded by the new debt of WCI. And don't forget that new debt is not taken out by max value, it's taken out by WCI, the firm that they're buying. And the 80 million is max value's own cash, 80 million of their own cash that they're using for this purchase. So that's why it's E, okay. So with all this information, max value, God help them, is asking us, fools that they are, to find out the free cash flow to owners that they'll enjoy, assuming that it's valid to model Workclose Inc. as a perpetuity, and also the appropriate equity cost of capital for discounting, and they'll say to use CAPM, whatever, that's fine. And then the PV of all the future cash flows to the owners, and we use the perpetuity formula for doing that. And then finally, with all that in our pocket, we can find out the NPV of this project, which is what? It's just going to be the present value of all those future cash flows we get from the firm minus E. E is what max val paid to own firm. Right? And that's 80 million, not the 100. The total price to buy the firm was 100, but Max Val only put in 80 million of its own funds to do that, and the other 20 million is D. All right, so I think we can actually do this. Let's go ahead and see if we can suss this out. So let's go step by step. Let's take first of all the free cash flow to owners. Okay, so in general, what do we got here? We've got, this is the key equation that I said you should know. Okay, so in some future year I, the free cash flow is going to be net income in that year plus depreciation minus change in working capital minus capex in that year plus change in debt in that year. But remember, in this model, we have this great simplifying model that WCI is operating in steady state, no growth or shrinkage forever. So what are the implications of that? The implications are that the net income is going to be the same every year, capex will be the same every year, depreciation will be the same every year. These all remain constant forever, so we don't have to worry about the I, right? That's good. We don't have to worry about year 1, year 2, year 3, year 4, year 5. All we have to worry about is any old year because they're all going to look the same, okay? And if the firm is truly in steady state, the working capital is not going to change. Working capital would only have to increase if the firm were growing and decrease if the firm were shrinking. So the changes in working capital every year are going to be 0. And if the firm is in steady state, as we learned in our ratio analysis chapter, the capital expenditures they have to make every year are going to exactly match their depreciation. So in other words, as sewing machines wear out, they buy new sewing machines, et cetera, et cetera. So these things are in tune and equal. And also, if they're in steady state, the change in debt is, there's going to be no change in debt after taking out the when the firm is purchased, after the firm is purchased, there's going to be no change in debt. So change in debt is equal to 0 after they take out the firm. WCI takes out that $20 million loan at T equal to 0. So we can say here, to simplify, that FCFEI is equal to FCFE. I can't do subscripts with this, so you just got to sort of bear with me. And also, we can get even simpler with this. The free cash flow in any given year is going to equal the net income. And let me show you how that works, because this also helps us simplify things enormously, okay? All right, so why is that? Why is that true? Okay, this is true because remember, in steady state, I'm going to get rid of this underlining, and in steady state, the depreciation matches the capex. So these terms exactly cancel, okay? And we said the changing working capital is 0, so that goes away. And finally, we said once we get them levered the way we want them at T equals 0, there's going to be no further change in leverage, so delta debt is equal to 0. So what's left? All that's left is our beautiful net income. So this is a fantastically great simplification that we've got here. Otherwise, we'd really, we'd have to do a little hard work figuring out depreciation, all these things. So happily, with this model, we don't have to worry about that. Okay, so now let's compute the income statement. This is income statement for the post-purchase capitalization of the firm. And we'll remember that the RD pre-tax is 7.25% and the tax rate is 40%. So I just want to go through, here's the income statement they have before purchase, and I want to create this income statement post-purchase for them. So I'm gonna do this in Excel just to make things a little quicker. So I've got revenue, I've got my depreciation, I've got other, and I've got equal, I've got EBIT, And then I've got interest, and then I've got my EBT, and then I've got my tax, and then I'm going to have my net income, which is equal to my free cash flow to owners. All right, so after the firm is purchased with this loan of $20 million, is that going to affect the revenue? No, right? So that's still going to be 88. The depreciation is not going to change, so that'll still be 30. And other expenses, that's not going to change either. That's going to be 40. So to get our EBIT, we've got this guy minus these two guys here. And our EBIT is exactly what it was before, exactly as we would expect it. Okay, and our interest is equal to it's going to be the, what do we have here for our interest? I've got to go back and look at the terms. So they pay 7.25% on their debt. So that's 20. So that's going to be 7.25% times 20. Okay. And let's just put that in here. Okay. And that's 1.45. And our EBT is just our EBIT minus our interest here. And now our tax is equal to our tax rate times EBT. So that's going to be 40% times 16.55. Okay. And equals 0.4 times that. And that's 6.62. And that's going to give us net income of, let's see, our EBT minus our tax, and that's 9.93. So the key thing that I want down here is 9.93. So we do have, as expected, we've levered up the firm. The net income is less, but because of the tax shield effect and because it's a profitable firm, that's going to increase their ROE. And also it helps them a lot because they only had to cough up $80 million to buy this firm instead of $100 million to buy this firm. Okay, so far so good. All right, so what I've got here is a complete version, working my way through from net income to free cash flow with this equation, just to show you that it's true, it's really true that if we work through the equation that I asked you to memorize, we're going to get the same answer. So I go through here, I get the net income, just like we got over here, okay? But I want to get my free cash flow to owners using this complete equation, okay? So I take now my depreciation, I add that back, okay, that was 30, I add that back. The changing working capital is nothing because it's a steady state firm. So now I've got these three terms done here, and my subtotal for that, cash flow from operations, is 39.93. But now remember, the CapEx is exactly matching the depreciation. So I've got minus 30 million. They've got to spend that in CapEx every year to keep the show on the road and stay steady state, but that exactly cancels with the depreciation up there. And after they have increased the debt once to 20 million at t equals 0, they never change it again. So there's my change in debt term, and I add everything up, and my free cash flow to owners is 9.93, and that is in fact equal to our net income. Okay, so now let's move on and compute our equity cost of capital for the post-purchase capitalization of this firm. So we were given for an unlevered firm the beta of comparable firms with no leverage, again, that's why I have the U there, was 1.1. And remember, we did learn in the last handout that as a firm gets levered up, its beta does increase. It's really true. It's found to be true empirically. And the best way of modeling that is to use Hamada's equation, which I didn't ask you to memorize, and I'm not asking you to memorize now, but I just want to show you how it works. So we can get the levered beta, which is actually the correct beta with that 20 million loan for WCI by using Hamada's equation. We have the 1.1, and we're just going to multiply that by this mess. 1 plus 1 minus the tax rate times D over E. So we go ahead and do that. And again, I won't ask you to do this, but I just think it's good to see how it works. So as we lever the firm up, we use Hamada's equation to show that in an unlevered condition, the beta is 1.1, but it's bigger, it's more volatile. That makes more sense that it's more volatile because it's a riskier firm now with more debt. The beta with that 20% leverage is 1.265. So now we're ready to use CAPM to estimate our RE. We have everything that we need. And remember, we said they went out and found the risk-free rate looking at treasuries as a proxy for that. That was 6%. And then plus, I'm just plugging into our old familiar CAPM equation here, okay? And for RM, they believed that the average return of the overall stock market was 11%. And the RRF, same thing, 6.0% here. And now we need to multiply that by 1.265. Okay, and let's see what we got here. Okay, I have 0.123, and let me just get another decimal place there on that. So that's a little bit better, 12.33% here. All right, looking good, looking good. So that's the discount rate we're going to want to use. So I think we've got pretty much everything we need now to get the NPV for this project should they buy the firm. So the NPV is going to be minus the amount of money they pay to buy the firm. So that's the 80, again, not the 100. It's the amount of money that they've put in as equity from their own bank account, right? And then plus this is going to be the PV tote from the Perpetuity Equation, which we've already pretty much gotten here. That's the just the net income, which we have to discount properly. Okay, so let's see, that's saying the same thing. And with our perpetuity, we've already shown the free cash flow in any given year is the net income. So the present value of all the future cash flows they're going to get out of this firm, if it lasts forever, not growing, not shrinking, and max value lasts forever, is going to be what? Let's get that net income free cash flow number, which of course I don't remember, whoops, even though it was right here all along. All right, so I've got my 9.93, whoop, 9.93, and that needs to be divided by 12.33%, and let's see what we get there. 80.54 to 2 decimal places. Okay, so that's the present value of all the future free cash flow dividends that they would get from the firm if it stayed in steady state forever and they were lucky enough to live forever and own it forever. So now to get the NPV, we just have to put in there the big blob of cash, of their own cash they're using to buy the firm, and let's go ahead and do that. So we've got minus 80 that they put in to buy the firm, plus the present value of all those beautiful cash flows they're going to enjoy until hell freeze is over, okay, and that gives us 0.54. And in most circles, 0.54 is greater than 0. And we know using our NPV rule, that makes this a good project for max value. So this model suggests that they should go ahead with that project. And again, as we've seen, there are a lot of problems with this model, but it's a good, simple model if they feel like for something like 10, 12 years, the market's going to remain stable, the firm's going to remain stable. It's not the worst model in the world to use. Okay, so let's look at another example here. Let's look at valuing a company for owners in a little bit more realistic situation. This is going to be, instead of purchase, hold forever, this is going to be purchase the firm, manage the firm, and sell the firm. This is, as I've got down here, jumping ahead, this is a typical private equity firm strategy. So let's see what we've got here. So they buy the firm, if you're a PE firm, and you manage it to improve its free cash flows. Or maybe you just bought a good firm in bad market conditions, like, for example, in April of 2020, and just wait for market conditions to improve and you'll be able to sell it for a profit. And that's the last step here, is sell the firm for a profit, hopefully. So if we do that, our Npv equation for the Npv for the project, buy this firm, manage it for a while, and then sell it, becomes, here's the blob of money that we use out of our own pocket to buy the firm. It's probably less than the sale price of the firm, right? Because we're going to maybe take out a loan to help us with that. And then this piece here is the set of free cash flows that we get every year as dividends while we own the firm. We're going to own the firm up until year end. Okay, so every one of those years we get a free cash flow, and of course we want to discount that back to t equals 0. And now we have a third piece here, which is our SPE. This stands for sales price to owners, and then of course we need to discount that back to 0 too. That happens at time tn, so we have to discount it back by tn. Okay, so let me see, just make sure I haven't missed anything down here. Yep, I think I've covered everything down here that we talked about up here. So let's move on to the next slide. Okay, so how are we, in this case, going to compute the free cash flows, and how are we going to estimate that sale price when we sell the firm? Okay, so the free cash flow to equity, guess what, is same as always, right? Right, the free cash flows come from this equation, and same as always, in general, to get these projections, we're going to have to estimate future income statements, balance sheets, cash flow statements, okay? And when we project these things forward in what's called pro forma projections, we calibrate them so that the amount of dividend in every year is the maximum amount that can be dividended out without screwing up the future of the firm. Okay, now let's think a little bit about how private equity firms typically get that sale price. So I'll just show you one way here that is very, very common. So we have to go back, think about ratio analysis for a little bit, and in particular the PE ratio. And remember, the PE ratio was the market value of the firm's equity divided by its net income. So private equity firms use this to help them estimate the sale price. And let me show you how it works. So first of all, they'll use projected income statements, projecting out to the year of the sale, and then they'll multiply that by their best guess at what they think the PE of the firm will be at the time of the sale. So the PE firms, this is the PE ratio, not the PE firm, the PE firms, the private equity firms, have a lot of data on historical PE ratios for various types of firms in various industries. So when you're in a recession, the PEs will be low, and they can say, you know what, when we're in good times, if we look back the past 40 years, the PEs in good times are 1.5 times what they are in recession. So we think we can get a PE of 1.5 times what it is now in a recession, something like that. So that's their general idea. They use some methodology like this to estimate the sale price in the future. Okay, quick note on taxes. So all the cash flows in this analysis and in this chapter, in fact, are to and from the PE firm for the project, buy, manage, sell this entity. And these are always after all the entity's taxes. So the entity is done paying any taxes it's going to pay. But the private equity firm, just keep this in mind, they still are liable for additional taxes on this project, right? If they get dividends, they or their owners are going to have to pay tax on those dividends. And when they sell the entity, they're going to have to pay a capital gains tax. Okay, so just good to keep aware. We do have taxes 100% included and correct from the entity's perspective, but the private equity firm has another level of taxation that we're not dealing with because we're focused on the entity right now, not max value overall as a firm. Okay, and you can learn more about the taxes that max value will have to pay on that gray page, but you don't have to. So let's do an example now using the purchase, manage, sell model. Let's ask the eternal question, should a private equity firm purchase Super Containers Inc., which we'll call SCI for short. So max value is back in action again here, and now they're looking at another firm, which is Super Containers Inc. or SCI. So what does SCI do? It takes shipping containers. You might recognize this as formerly a shipping container. It converts them into pop-up stores and other commercial types of applications. This is a pretty stable business with stable future prospects, so slow to no future growth. It's again a well-managed family business, and it's offered for sale for $120 million. Okay, and recent operating information for the firm. We have an income statement here. So remember, it's a stable firm, so this will work for Okay, so part of our modeling assumption here is going to be, again, the firm is stable. So revenue in any given year, 150 million. These are in millions again. Depreciation, other expenses, EBIT, interest, earnings before tax, tax net income. So they've got about a 10% profit margin here, which is, again, pretty good, especially for an industrial company like that. What else do we know about them? The interest is from a $70 million loan where they're paying pre-tax RD of 8%, and the tax rate is 35%. Okay, so here's the current market situation when max value is considering this. The overall market for purchasing small niche companies like SCI is in a deep slump, something not unlike maybe April 2020 in the middle of the COVID virus pandemic. Max value notes that, irrespective, this hasn't impaired the performance of SCI or its future prospects. So SCI is still doing pretty well. And you could imagine in the COVID crisis, they could be making a lot of hospital annexes, COVID testing sites out of containers, things like that. So irrespective of bad market conditions overall, this company is doing very well. And max value believes, as a lot of people do in April of 2020, that markets will generally be recovered in about 2 years. So here's their strategy, given all that information. So remember, the project for them is purchase, manage, sell this company, okay? So they're going to start out by buying all the equity today for that asking price of $120 million, okay? And they're going to leave the leverage as it is, okay? So the company has a $70 million 8% loan, and they feel like that's about the optimal leverage for this company, so they're not going to touch that, okay? And then what they're going to do, being the opportunistic private equity folks that they are, is they're going to operate the firm for 2 years when they believe the market will have recovered. So clearly they're buying low and planning to sell high here, and their estimate for selling high is that in 2 years after the market has recovered, they will be able to sell the firm for $160 million. So that's not bad, 120 to 160, plus they're going to get free cash flows for 2 years along the way. So that's looking pretty good. All right, so let's look at the financing structure and some other things. Okay, so when they're buying the firm, so the debt they already have this existing loan of 80 million, and they're going to leave that unchanged. What else is going to be important here? E, the amount of money they're going to put in from their own pocket to buy this firm is 120 million, and they're going to get 100% of the firm's stock for that. Okay, and so the total capitalization of the firm after it's purchased is 120 plus 80, right? Total capitalization is always D plus E. So they've got the D already, they've got their E they're going to put in, so the total is 200, okay? And the weight of debt we can compute from that. D over D plus E is 40%, and that means, of course, that WE is equal to 60%, right? Because WD and WE have to add up to 100%, okay? So we can talk a little bit about the discount rates. The pre-tax cost of debt capital for them, let's put in pre-tax cost of debt capital is 8%, and that comes directly from the interest rate on the existing loan, okay? And someone has thankfully computed the equity cost of capital for us at 10.31%. And how did they do that? They used CAPM or something like that to get that. And the income tax rate of the firm is 35%. Okay, so here's some of the key data that we need for the firm here. Okay, so our job, okay, they're entrusting us once again, fools that they are, okay. Is this a positive NPV project for max value? So how are we gonna go for this? There are a lot of different orders that we could solve this in, but let's do it this way. Let's start by getting all the cash flows for the project. I wanna get all the cash flows for the project because once I have them, it's gonna be relatively straightforward to just discount them all and add them all up together. So the cash flows that we need are purchase price, sell price, and the free cash flow. This is going to be for 2 years, right? They're going to own the firm for 2 years and sell it. So there's going to be a cash flow end of year 1, cash flow end of year 2, and each one we're going to have to discount back to t equals 0 using our equity cost of capital. Okay, and let's see if we've missed anything here. Nope, I think everything that I've got down here, we've already discussed up here. All right, so starting to get these cash flows, the first one, the price they're going to pay for the firm is 120, and that's going to be, in this case, for 100% of the common stock. So Max Value will be the sole owner of the firm after this deal. Okay, now let's get the free cash flows from managing the firm, okay? And in general, as you know, for any future year, we really have to use this equation. But once again, with this steady state assumption, we can really simplify things. The net income in year 1 will be year 2, CapEx will be the same, depreciation will be the same, and if it's steady state, changing working capital is going to be 0, CapEx is going to match depreciation, and the change in debt, we already know, is going to be equal to 0. So what can we say? The free cash flow in each year is going to be the net income in I, and that's going to be the net income in any old year because it's steady state. So the net income is the same every year. And that's what I've got down here. Free cash flow in year I is just FCF E in general, and that again is just equal to net income. Okay, so our free cash flow, and here I've gone through the whole mess again for you so you can see it really does work out that the free cash flow is equal to the net income in this steady state case. So the free cash flow here, it's equal to our net income, and that's equal to 15.34. Okay, so here as purchased is exactly in this case, the as purchased is equal to the pre-purchase. And why is that? That's because it's steady state and they're not making any changes. They're not changing the leverage. They're not changing anything. Okay, so now the sale proceeds when they sell the firm. So that happily someone's already estimated from us. And this was done most likely using a PE analysis. And I'll talk about that a little bit more on the next page. And let me just put in here to make sure that's clear. Ratio analysis. Okay. So we're ready to go. We have all the cash flows. They've given us the equity cost of capital to discount everything with. So really all we have to do is plug into our NPV equation. Okay, so this is going to be big. So we start off with minus 120. That's our price paid by equity in the beginning. Okay, plus what's that free cash flow from operations? I forget. That's 15.34. 15.34 over 1 plus, I need to also look up the cost of equity capital. It's back here somewhere, 10.31%. 10.31%. Whoops, what happened there? And that wants to be discounted back by 1 year, and they get another year of that. So that wants to be discounted by 1 plus 10.31%. And that's the one that they get, that's the free cash flow they get from year 2. And then the sale price is that 160, and that happens at end of year 2, just after they get the dividend. They wait till they get the dividend, and then they sell the firm the next day. Okay, and that needs to be discounted back. Also, I just want to make myself a little more room here. Okay, and that's it for the NPV. So let's see. Let's see if I have a typo in here. I'll just check it quickly. Yeah, I think it looks good. Let's put it in to Excel and see what we get. Oh, there's a typo. Let's see what happens. Yeah, so something's wrong with my equation there. And let me see. 1.3. Aha, that's what's wrong. So I need a okay, there we go. So a little typo there. Let me correct that. Missing a plus sign. Oh. There we go. Now that's corrected. Everything's looking good. And the answer there was 38 equals 38.0. So that's the NPV of this project for these guys, including all the extraordinary assumptions we talked about along the way, steady state for 2 years, et cetera, et cetera. But you see the nice thing here, you can use the steady state assumption, and you don't have to make a perpetuity out of it. You can just say it's happening for a couple of years, stable market, that sort of thing. So anyway, we do all of that. We get a NPV that is greater than 0. Okay, and so this model is telling them very clearly to go for it. All right, so there's two reasonable, very simple, but also very reasonable analyses for buying a firm. The first one, where we used the perpetuity, was clearly very quick and dirty. But this second one is actually pretty good. If you have a firm that is relatively steady state and you're buying it for a kind of short term, you're buying in a recession and you're planning to sell it in 2-3 years after a market recovers, the analysis that we did here for this company is actually pretty good and pretty reasonable. Okay, so last thing I want to talk about here is how max value estimated that 160. And remember I said that PE firms private equity firms use PE ratio analysis to do this a lot. So they use the fact that the PE ratio is the market value of equity divided by net income. So what did max value do in this case? They note that PE ratios fluctuate with market conditions, and that's definitely true. So the PE for any firm in a depressed market is going to be much less than its PE ratio in a good market. So in this depressed condition where the price was 120 for the firm, the PE ratio was only 7.82. And what they did then was they looked up historical PEs of comps, of comparable firms in a good market. They pay for this database. They pay maybe $2,000 a year for this kind of database. So they look this up and they take the average of comps in a good market, and they find that in good market conditions for publicly traded firms like this, they have a PE ratio something like 10.43. Okay, then what do they do next? They assume that SCI's PE ratio will converge to this good number when the market recovers. Of course, it's not going to be perfect, right? But it should be somewhere around there, okay? And once they have the estimated PE ratio for 2 years from now, and they have the definition of what the PE ratio is, they can get an estimated sale price, right? So they just take the net income at time of sale times the good market PE ratio, 10.43. So that's 15.34, because remember, it's steady state firm. The net income's not going to change, times 10.43, and that's how they got to their 160. So with that, that's pretty much, I think you have the basics now of how to go ahead and estimate the value of an entity to owners in at least one sort of semi-realistic way of looking at it, which is completely represented by the example we just did here. So private equity firm type of thing, buy the firm, manage it for 2, 3, 4, 5 years, then sell it. Okay, and with that in our pocket, I'm gonna leave you and look forward to catching up with you again soon.